Good morning from our global headquarters in New York. I'm Fabienne Cretin-Fumeron. You're welcome to Bloomberg Brief. Let's set your agenda. Embracing the risk on with a message from the Fed. Many more cuts ahead. A stimulus blitz, China unleashes a raft of support measures to shore up growth. And we're live from the 5th annual Liquid Alternatives Summit in London. We'll bring you our exclusive interview with Cliff Asness, AQR Capital Management's co-founder. Very good morning. Take a look at risk. Equities are nicely bid. Is it an extension of a melt-up, of FOMO, of Tina? You take your choice of which superlative you want to do. But the Fed's narrative from Goolsbee was how tight the real rates are. We'll talk more about that in a moment. You have stimulus coming from China. We've got consumer confidence today. And Nomura do warn that we are in a forced re-risking and exposure-grabbing market. Stocks a bit. S&P up by 0.25%. To the bond market, the narrative here is, even though input prices rose a little bit yesterday, we got small drift higher in yields this morning. Twos auction today, $69 billion worth of two-year paper coming today. And the collective narrative from the street, BlackRock, PIMCO, BMO and Morgan Stanley, is a continuation of this disinversion and steepening. By the way, BlackRock say there's a very aggressive normalizing away from restrictive rates. Let's stay to play on the bond and the equity markets. As I say, everything's getting a nice boost this morning. Part of the narrative is the China story, unveiling a package of monetary stimulus in an effort to revive the nation's economy. Jill DeCease is with us from Hong Kong. Jill, this is a mighty combo of reserve requirement drops and galvanizing the national team, one could say, for the stock market. What scale of stimulus are we talking about?
Yeah, that's right, Manis. So, look, this is about as much as you could really throw at the China slowdown from a monetary policy side as can be expected here. I mean, as you just mentioned, you've got some really big superlatives that we're dealing with here. This announcement of a cut to short-term policy interest rates and a cut to the reserve requirement ratio for major banks. That's the first time that we've had an announcement of that nature on the same day in about a decade. You also have, some lowering some borrowing rates affecting somewhere to the tune of $5.3 trillion worth of mortgages. That's a pretty significant move on the property sector side. And then, as you just mentioned, Manis, you also have some liquidity support being provided to help the stock market from the central bank to the tune of about $113 billion worth, alongside some other measures, including this exploration of a new stock stability fund. So where this all really amounts to is probably something that's going to help boost the economy to ultimately hit its economic growth target of about 5% by this year. That was something that was really, really out of reach just before all of these announcements came. Maybe there's still more to come. We'll have to see.
Look, the criticism last year was it was a piecemeal response by China. They were never going to make their 5% growth target. This briefing, what does it say to you about a shift in policy approach from China?
Yeah, Manis, I think that it's really about the communication style here more than anything else, right? So analysts were looking at the concepts that were announced this morning in China, saying, look, a lot of this is stuff that we actually thought that China needed to do anyway. So it's not really something that's to the scale of, say, bazooka-style stimulus that you were seeing after the Great Recession in 2009. But what we have seen is really sort of this shift in how China is explaining a lot of this and how they're all unveiling this. I mean, the PBOC governor, the central bank governor, Pan Gongsheng, coming out and giving this press briefing just before announcing tweaks to policy rates and such. I mean, this is something that would have been unheard of just a couple of years ago. And the fact that he also gave forward-looking guidance that more cuts were to come, I thought was particularly telling as well. So it seems that the market certainly took all of that and said, look, this is something to be excited about. We did see that reflected in equities markets in China and Hong Kong. Now, whether that actually is a sustained momentum, I think still we have to kind of wait and see. But at least for today, markets stood up, took notice, and said, maybe there's actually something to glean from this. Maybe China's actually taking this seriously.
Indeed. As you said, not the crisis response of the GFC, but of size and substance. Jill, thank you very much. Jill DeCease in Hong Kong. Joining me now is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, good to have you with us. So the size and the scale of this stimulus, in terms of the risk narrative, it's pro-risk globally. But I wondered, does it just reaffirm U.S. exceptionalism relative to perhaps the others? Your first take on the stimulus.
Thanks, Manny, for having me on. Look, I think the stimulus measures it's clearly positive, and there had been a lot of growing speculation that at some point in the near future, there would be some kind of announcement because it's been such a disappointing set of economic data over the last couple of months. So it's positive. But as Jill had said, this is very much on the monetary side. We're still waiting to see what happens on the fiscal side, because that's what I think is really required in order to boost that consumer confidence. If confidence is low, then reducing interest rates doesn't really do enough because there's just not enough demand for credit. So we need to see what happens on the fiscal side if it comes through in the next couple of days. And then the other side of it is how is it all going to be implemented? I think we've seen a number of occasions in the past where there have been some quite impressive announcements on the property side, but when it comes to implementation, it's been a little bit disappointing. So this is good news. We're still unconvinced about how long this is going to be sustained for.
Yeah, and it is about that convincing of markets, which takes us to the monetary policy here. And you say this about the 50 basis point cut, an unusually large 50 basis point reduction. It appears designed to preempt any significant economic weakness and signals that this Fed will go to historic lengths to secure a soft landing. Can you just expand on what you mean by historic lengths?
Yeah, I mean, moving rates by 50 basis points when you have growth kind of sitting near the high twos in this quarter, when you have no evidence of layoffs, there's no financial crisis brewing, no asset price bubble popping. So this is quite unusual. You've only seen those kind of moves when it's typically associated with something serious, crisis happening. So I think it is historic. That's not to say it was a wrong move. It was an unusual move. And I think everyone has to, in the way Powell said that it was a recalibration, we almost have to recalibrate the way that we think about the Fed's policy reaction function now. And I think the key thing here is that they have said that, look, we're committed to making sure that we secure that soft landing that we have in our reach. And this certainly does go some way to proving that.
I think Goolsbee re-emboldened risk quite solidly yesterday when he talked about just how tight rates were and his proclivity towards lower rates. I mean, when you look at what Nomura say, forced re-risking and exposure grabbing, is that what we're seeing in these markets?
I think there is some of that, certainly, because this almost has reset the tone. I think going into last Wednesday, there was some concern that if you get a 50 basis point move, at some point the market is going to retract because it worries what else is in the future. But Powell did a really good job of conveying their confidence in the broad economy. So when you have got rate cuts and you have a steady economy, that is typically really good environment for risk assets. The one caveat to this, though, is that valuations everywhere are very, very expensive. So in terms of how far it can go, when you haven't really had a pullback to clean out the market, I think that's probably the bigger question. But certainly from an exposure perspective, this is really the time to be risk on.
And just in terms of the drawdown, or there's nothing has interrupted us here, you still think that there's more miles in equity rather than credit, rather than, where do you deploy in the near term in this risk on environment?
Right. So we are certainly very much risk on the equity side. I think there is a trade to be had within the small cap space, particularly because valuations have been so cheap, and it is very much that kind of stronger, at least more positive economic environment. Also, though, from a credit perspective, we had been overweight a lot of the core fixed income space, particularly IG coming into Wednesday. I think we almost have to revisit the expectations around high yield, though, as well, because if you are looking at an environment which has a lot more confidence about the economic outlook, then it means that defaults are unlikely to spike. And although credit spreads within high yield are tight, it still does provide you that income without that much risk that maybe had been there pre-last Wednesday.
Look, there's a great debate out there that we're so risk on, we're so FOMO, we're so TINA, that the left tail risk is thoroughly banished. Is it thoroughly banished for you? Is there any hesitation at all?
I don't think it's entirely banished. I mean, I think the number of people who are still long duration with some exposure to treasuries is that caveat that if there is a growth slowdown, which is entirely possible, then you still want to have that safety exposure. I want to say, though, that the China stimulus measures, if it does come through, that does actually change it does further improve the outlook globally and particularly for the US, because typically when there has been a global growth slowdown, there has to be some kind of engine of growth from somewhere. And if Fed loosening isn't enough to boost the US economy, but China's policy stimulus is, that could be enough to really improve risk sentiment even further. So I think there's a lot of moving parts to this story today.
Yeah, it's interesting how that China story will wash up, as it were, in the pro-risk story for the US at the same time. Seema, thank you very much. Seema Shah, first reaction there on the stimulus measures and the markets. Other stories trending on your Bloomberg terminal this morning. This is what we've got for you. B. Riley's $2 billion debt load has prompted its bankers to hike the interest rate on the company's key loan and cut how much it can borrow. The deal requires the struggling firm to cut the balance on its term loans to $100 million within the next year and eliminates a revolving credit line. The FTC is expected to allow Chevron's $53 billion takeover of Hess. The takeover was announced 11 months ago. The FTC could announce the decision as soon as this week, the time to complete the deal. Chevron still needs to win an arbitration case filed by Exxon and China's CNOOC. The U.S. Justice Department is planning to allege that Visa illegally monopolized the U.S. debit card market. The Antitrust Division is set to file a lawsuit in the federal court, which may come today. The U.S.'s largest payments network stands to be accused of a range of anti-competitive conduct. It includes making exclusive agreements to hinder competing networks from entering the market. Coming up on this show, Cameron Dawson of NewEdge Wealth anticipating the Fed move patiently towards neutral. We'll catch up with Cameron a little bit later this hour. And we're live to London to my co-host, Danny Berger. This is Bloomberg. It's Bloomberg Brief. I'm Fabienne Cretin-Fumeron in New York. Danny Berger is on assignment. The hedge fund leaders and investors are gathered at Wembley Stadium in London for the 5th annual Liquid Alternatives Summit. Danny sat down with the AQR Capital Management co-founder Cliff Asness.
The bigger question I'm trying to answer is I see this as a sign of the market getting less efficient about pricing. And in principle, we all think things should get more efficient over time. Technology marches on. Data is more available. Things that were available at a lag are available instantly now. But I think most of those things go to speed, not to accurate pricing. Yeah, things get in prices faster. But I think there's strong evidence, so not just these two things, but these are the two major ones I experienced, that the crazy periods are getting crazier and lasting longer. So the next question I ask in the paper, and this is very speculative, I admit, is why? Why? And there are probably other great ones, but I focus on three, and I'll say them really fast.
Sure.
The first is the rise of passive. That's everyone's favorite. Passive has broken the market. I think that is probably part of it. No one knows how many people can actually be passive without breaking the market, but we know it's not 100%. That's a weird world where nobody is thinking about whether NVIDIA is worth more than a candy store.
Yeah.
So the idea that there would be less could weaken the tether to reality.
I want to let you get to the other two, because
sure.
I find them really interesting. But just in terms of that, especially when we're talking about NVIDIA, and this being a crazy period.
You know quants know nothing about individual stocks,
Of course, you know
right?
nothing about a single stock. I'm very aware of that. How crazy is this period?
We're still, and I won't talk about NVIDIA in particular, but when it comes to the spread between cheap and expensive stocks, we were at a new 100th percentile in COVID. I jokingly call it the 120th percentile, which from my math friends listening to you, there is no such thing. It's just the new 100th. But it was about 20% above the prior 100th. We're back down to about the 80th percentile spread versus history. We still have a little bit of a tilt on, but far smaller than when it was 120. So I would say things are still out of whack, but it's not an arbitrage you can drive a truck through
Right.
now. But so I think passive is part of it,
right.
But it's very hard to know how much. The second one I'll do beyond quick. Post-GFC, 10, 15 years of super low interest rates. I don't think justifies these spreads, and we've written a lot about that. But in a very non-technical sense, may that drive investors mad and to do some crazy things? Yes, that's all I'll say about that. My third and favorite hypothesis, because it's so counterintuitive, is I started out saying technology might make things faster, but not more accurate. It might, and in fact, I would argue probably does, contribute to the less accurate pricing. And in particular, I'm talking about the milieu of instant information, free trading, certainly social media. The dot-com bubble was the first go-around of kind of proto-social media. where you're a little too young for this one, but message boards were very hot. People are all discussing their favorite e-toys and drcoop.coms and if markets are efficient to some degree, not perfect, the wisdom of crowds, the famous idea that a crowd can be more wise than the average component of the crowd, is a huge part of it.
How much of your Twitter interactions color this? Because you're not afraid to talk to, I just, when you're talking to people who you don't agree with online, does some of that color it saying, maybe this crowd isn't so wise?
I hope not. But may it sneak in? I would have to admit it might sneak in. But if a wise crowd is the goal in a market, have we ever had a vehicle better than social media for turning a wise crowd into a dangerous mob? And I'm not going to get political, except I'm not going to choose a political side. But if our politics are not a great example of this, I mean, there was a point 20 years ago where we had utopian views with that social media would make us all like each other more. I don't think I need to convince any of your viewers that that has not happened. And I think a lot of the same has creeped into markets. It's unfair to choose the most crazy example, but a poster child, not a proof, are the U.S. meme stocks. They are the most extreme example of what I'm talking about.
Right.
Crazy valuations driven by social media. But life is not just them and everyone else. It's a point on a spectrum. So I do think markets have gotten somewhat less efficient.
Right.
I think the final interesting question is, what does that mean for a rational style of investing?
Can I ask, because you also point out in your paper that it's a problem for society.
Yeah.
Why is it a problem for society?
Well, if you're actually going to read the paper, it's going to make this all take longer. You know that, right? It's a problem for society, and I think I'll be a cheerleader for our industry.
Yeah,
I don't
we
think
got to be quick here, Cliff. Only 30 seconds.
I don't know if enough people think about it this way, but rational prices are very important to a free enterprise society.
Yeah.
When prices are wildly irrational, prices are how we allocate resources.
Yeah.
And we do it in a very unproductive way if companies that are not very productive and are speculative and pie in the sky are getting all the money.
Yeah.
So it matters.
Cliff Aston's there, AQR Capital Management co-founder, speaking to my co-host, Danny Berger, who is at Wembley Stadium, I think it is. Danny, good morning. Good to see you. Great conversation. Crazy markets, which are not very efficient. That puts the fear of God in me. Good morning.
Yeah. Good morning. And it creates a problem. First of all, Manus, great to see you. Look at this backdrop I'm in. For some reason, they're mowing Wembley Stadium right now. You might hear a little bit of that. There are no trees to speak of. I'm not too sure what that is. But nonetheless, you're right. It's a problem. If markets are less efficient, what does that mean for someone like Cliff Aston? You could kind of hear him opining on it, and he thinks a lot about it in terms of society. He sees the entire crowd, because usually when you invest, you say, okay, markets are somewhat efficient because there's wisdom in the crowd. Cliff Aston thinks that the crowd is no longer wise. That because you can have anyone invest who you want to, you just go on your app, you download whatever your favorite investing app is, you can talk to people about it on Twitter, you get these strange dislocations. You get NVIDIA going to the sky, and you get political environments which become more contentious. So he actually sees those two issues as inextricably linked, which, again, it's an election year, so that's a problem, and he needs to navigate these markets, Manus.
And it's interesting when he talks about whether markets are cheap and expensive and reflecting back in a post-COVID world. And again, it is that debate. We've got lots of notes in our inbox, Danny. Nomura this morning are talking about a forced re-risking, exposure grabbing. Ed Yordeni yesterday talking about melt-up markets. So again, it's trying to define whether we're in some kind of crazy melt-up mode.
And what do you do in that crazy melt-up mode? If you're an asset manager and you have a contention like Cliff Aston does, and he talked to me this morning, that markets would mean revert, that at some point value would play out. He's, of course, talking his book because AQR is largely a value investor. But what a less efficient market means for him is that those crazy periods last longer, that he really needs to grit down and be convinced in his bet that it will work out. But it gets harder, Manus, because, again, it's crazy, and maybe you have clients who leave because it doesn't play out. I should say AQR's returns, they have been solid. During COVID, there were some issues, but when that value resurgence started to come back up, AQR did better. But for them, it's a more difficult period. You just got to brace it as the craziness continues.
Embrace the inner crazy. And I like the fact that you were called young. There you go. The defining line. The defining line. Danny, great to see you. We're going to see you a little bit later on, and enjoy your time at Wembley there. Danny's next interview, a little bit later this hour. Fabienne Cretin-Fumeron, Carmignac Fund Manager, joins her at Wembley. Coming up in the show, a look at what else is making the headlines around the world this Tuesday morning. We'll discuss Israel's latest airstrikes targeting Hezbollah in Lebanon. Context matters on Bloomberg. It's Bloomberg Brief. I'm Fabienne Cretin in New York. Your front pages, this is what's making headlines around the world. First up on Bloomberg, Israel airstrikes on Lebanon kills hundreds in a major escalation. Nearly 500 people have now been killed in Israel's latest strikes in southern Lebanon, targeting Hezbollah. It is the deadliest bombardment on Lebanon since 2006. Up next, Wall Street Journal leads with Trump. Issues fresh trade threats targeting Deere. The former president threatens to slap a hefty 200% tariff on the farm equipment maker John Deere if he's elected. More on that story a little bit later on. The FT goes with Andrea Orchel, sends Germany into a frenzy. UniCredit more than doubled its stake in Commerzbank. Berlin is not happy. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Fabienne Cretin. Let's set your agenda. Embracing the risk on with a message from the Fed. Many more cuts ahead. A stimulus blitz. China unleashes a raft of support measures to shore up growth. And we're 6 weeks away from the U.S. elections. More on the former President Trump's economic agenda coming up in the show. Good morning. Choose your superlative. We continue to trade higher in these equity markets. Is it melt up? Is it FOMO? We've just had a conversation with Chris Asness of AQR talking about crazy lasting a little bit longer. Nomura warned that we are being forced to re-risk and take exposure. We're grabbing exposure. Nonetheless, these equities are higher this morning. Roll it over, have a look at the bond market, and what you will see is we're getting ready for $69 billion worth of two-year paper to come today. That will be interesting. Yields popped just a little bit higher this morning. The input prices, the highest of 2024 yesterday. But again, the narrative continues from Goolsby, Kashkari, etc., which is just how tight these rates are at the moment. The building narrative from the street, from BlackRock, PIMCO, BMO, Morgan Stanley is keep on going with the steepeners, and there is a global disinversion taking place in these bond markets. So as I say, the Fed officials are cautious, but they are keeping the door open for another large rate cut. Let's take a listen to what Chicago Fed President Austin Goolsby had to say.
If conditions continue like this, there are a lot of cuts to come over the next 12 months. There's virtual unanimity about that. So whether the next one is 25 or 50 or 0 or whatever, my view is over the next 12 months, we have a long way to come down to get the interest rate to something like neutral to try to hold the conditions where they are.
Joining me now is Cameron Dawson, CIO of NewEdge Wealth. Good morning. Good to see you.
Good morning.
So Goolsby, I think, went on to qualify a few more things. We're hundreds of basis points away from neutral, and he really focused on how tight real rates were. Is that myopic or hopeful for you?
I think it is rather myopic, because if you look at the empirical data in the economy, it's hard to argue that things are falling off a cliff. GDP growth is still well above trend. You also have a labor market that, yes, it has softened around the edges, but it's broadly still healthy. And then broad financial conditions are still very easy and in stimulative territory. So it's interesting that the Fed continues to focus on financial conditions in a very narrow sense, which is just looking at real rates. And yes, real rates are elevated, mostly compared to the last cycle. But if you broaden out and include things like credit valuations, credit spreads, look at stock valuations, all of those suggest that financial conditions are loose. So it raises the question of what could the potential ramifications be of doing hundreds of basis points of cuts with this backdrop.
Well, then that's when you really juice the market and the economy. But then it raises the other question, which is perhaps the consensus is correct in the building, and that the neutral rate is actually higher than we all think and than what the Fed thinks.
And Powell did say last week that he thinks that the neutral rate is, in quotes, significantly higher than it was in the post-Great Financial Crisis period.
Yeah.
And so if we do see that neutral rate creep higher, it just suggests that there is a higher floor under rates than what is currently being priced, because the bond market does have us getting to neutral by January of 2026 at the current forecast of about 2.9%. If that continues to creep higher, this says that they won't cut as deep as what the bond market's expecting. The question, of course, would be if the equity market really cares about that. We think at the end of the day, as long as growth holds up, the equity market doesn't really care if they don't get all of the cuts that are currently priced in.
So if the equity market doesn't care that they get all of the cuts priced in, are we in some kind of a forced exposure grabbing narrative, as I said, from Nomura?
It is very much a risk that you see a chase and the potential of a bubble brewing. Let us not forget what happened in 1998 post those cuts following LTCM, where you certainly saw that added bit of liquidity spark a massive bubble that was great in the short run, but highly destabilizing in the long run, as the NASDAQ took 14 years to make a new high post the peak in 2000. So that is...
You don't think we're really back in that kind of phase, do you?
We're not there right now, but the risk is that we get there if you add a lot of liquidity. I think you have to appreciate the starting point of high valuations today and high positioning. If you look at household equity positioning, they're still just only about 1 percentage point away from 20-year highs, which just says that how much more is there on the sidelines to be drawn in? The answer to that is leverage. And that's where you would start to get into these questions of destabilization in the medium term.
So it's interesting you talk about the money on the sidelines, because from where I'm sitting, 50 basis points doesn't shift the needle for money markets. 100 basis points, I would say, this is a personal view, I would say 100 basis points really begins to turn the tap from money from the sidelines.
We've often raised the question, though, of how much of money market money will actually flow into the equity market, meaning that is it as fungible as people think, that people are just waiting to get into equities? We think it leans a little bit more into fixed income, of people extending duration. That's much more of a consistent kind of asset class. But to your point, if you continue to see markets melt up and drift higher, that of course sparks a chase, sparks risk-taking activity, which feels really good in the now, but certainly creates risks over the 5-10 year period.
You sound a little bit hesitant. Everybody else is so bullish, right? I know your base case is things are good at the moment, but there's a hesitancy in you about what's going on.
Well, I think that we have to respect the trend in the short term. That has been the key message from this market really since the low in October, is that the market is absolutely defiant that you must respect its trend. And so we're not in a position to want to question that at this point. What we want to say is let's not temper to say that let's take on a bunch of leverage, let's add into positions in a very risk-on way. We think that there's a measured way to continue to have exposure to equity markets. We continue to see upside given the fact that you have this forward earnings estimates that do rise, but we want to be aware of the fact of that the starting point of this easing cycle is incredibly rare, simply because valuations, positioning, and sentiment are all starting very stretched.
Seema Shah was with me just 30 minutes ago, and as she said, look, there's a reset in these markets, and you need to embrace it. And perhaps one way to embrace it with a little bit more upside is that small cap valuations, in her view, remain cheap. So is that a pocket? Everybody talks about it, but is that now where I now deploy a little bit more?
If we think about the setup of the Fed aggressively cutting interest rates and having resilient economic growth, which is boosted by things like China's stimulus today, possibly a lot of fiscal stimulus in the U.S., that is an environment where small caps have typically done very well. Small caps need two things. They need low rates and strong growth, and that backdrop of a risk-on environment. So because positioning is light, valuations are low, it's certainly fertile ground for a strong snapback. The question is, can it last?
Look, very briefly, you mentioned China there. It was one of our headlines. To what extent does the China stimulus measures wash back up in a pro-USA risk narrative?
I think it has the possibility of lighting a fire under cyclical value. That classic sectors of things like industrials, materials, and energy, areas that have lagged or struggled this year that can get a boost because of higher commodity prices, higher kind of cyclical activity. Those areas seem to be getting a little bit of a lift, at least since the Fed rate cuts were starting to be priced in July in a more aggressive way. I bet that continues given this backdrop from China.
Okay, Cameron, thank you very much. Cameron Dawson there of NewEdge Wealth, her take on the markets. Coming up, we'll look at the deal making for the rest of the year. Fabienne Cretin-Fumeron of Carmignac Fund Management joins Danny at Wembley Stadium at the Liquid Alternatives Summit. Context matters on Bloomberg. It's Bloomberg Brief. I'm Fabienne Cretin in New York. Good morning to you. Hedge fund managers and investors from across the world are gathering in London for the 5th annual Liquid Alternative Summit. Danny Berger is on tour. She's at Wembley Stadium. Danny, good morning.
Good morning, Manis. Thank you so much. I'm very pleased to say we're going to have a conversation about merger arbitrage. I am here with Fabienne Cretin-Fumeron. She is a portfolio manager at Carmignac who leads the strategy. Wonderful to see you, Fabienne. Thanks for joining this morning.
Thanks for inviting me.
So last year and the year before was a little bit slow for public M&A. It has picked up. Just how many more opportunities are there for you now? Is merger arbitrage exciting again?
You're completely right. You know what? We have had like 4 years of declining cycle, declining activity. But since, I would say, last semester of last year, it's picking up. Let me give you just few numbers. Activity in terms of numbers of deals have been picking up by more than 38% compared to last year. And in volume, it's like 30% of increase, with a lot of mega deals being announced. For example, you have Kellogg's, you know, the cereals, being bought by Mars, and that's something like a 30 billion deal. So yes, the activity is back, and it's back in all the regions. US is representing like 55% of the activity. Europe is back. That's great news. Europe is back, 72% of increase compared to last year's, and UK is the most active country, with big deal in beer like Britvic, or with huge deal, and the books, WHS with Smith.
Well, part of the freezing up was when you had higher interest rates, the cost of capital was more expensive, less deals were getting done. Now that we've had 50 basis points from the Fed, you've had 25 basis points yet again from the ECB, the cutting cycle has started. How do you expect deal volume to pick up from here on out?
It's always difficult to have a predictive view, but for the moment, the activity is a bit slowed by the FTC scrutiny, and that's a main issue or a main risk that we've seen. Right now, we have 2 major litigation in the US, Capri Tapestry deal in the hand-bag sector, and in the supermarket, Albertsons Kroger. So the outcome of those 2 litigation will be known like mid to end of October, and this will have a huge impact on 2025 activity.
What sort of impact? Can you get into that? If some of these do end up being blocked and we still see more forceful regulation?
If if those 2 deals gets blocked, and it's always possible, because at the end it's a judge view, then I think we will have deals that are more prepared, we will have less mega deals maybe. So we'll still have activity, I would say, in medium-sized company, but maybe not huge and mega deals. If the 2 deals have green lights, then it's an opportunity for deals to come back. I would say more than the result of the US election.
Okay.
The result of those 2 litigation will have a dramatic impact.
How does it change your strategy, though? Not even just the result of that, but the fact you do get these deals caught up in regulatory crosshairs, that they take longer. What does that mean for you?
You're right. It means that it takes longer. If you go 18 months back, a normal deal will last between 6 to 8 months. Now you can add 4 to 6 months to that duration, meaning that if there's a little bit of overlaps, not huge deal, not huge thing, then you have to think that you will have a second request from the FTC, and then it will last longer. So you have to take that into account. So.
Okay, is that frustrating? I mean, how do you cope with that? Because you put these bets on, you assume these things are going to happen, and you just have to wait. Is it an issue of returns? Is it an issue of your investors saying, okay, we're ready for these things to play out?
It's not really an issue. It's an issue when it's when it takes more time. When we first had the impression that it would take 6 months and it takes 1 year. Now that we know that it will take 18 months, all the spreads and the return have adapted to that time. You see, and there is always something that come up. If we are back last year at the same time, we were focusing on Chinese blocking deals. And now it's on FTC scrutiny. Maybe next year will be EC or CMA scrutiny. We never know. What we have to do is try to take into account all those impacts into the spreads. And we think right now the merger up spread are well adapted to all those new issues.
What about some of these mega deals specifically around AI? Rumors, not rumors, but reports of Qualcomm looking at Intel, of Apollo investing in Intel, Microsoft buy some nuclear plant. A lot of deals seem to be concentrated around this. In terms of pricing around these types of things, there's so much enthusiasm of it, they can get sky high. How does that change merger arb when it's specifically these types of areas that there's just so much investor enthusiasm around?
Maybe you will have a higher premium. There is definitely tech is the biggest sector this year in terms of announced deal. I think it's 16% of the total deal announced are in tech. But we have a focus on that because we like that, right? And because it's the future. But this M&A cycle is also composed of the old economy and the new economy. So new economy, as you said, all the biotech, but also drugs with obesity drugs and a lot of deal in biotechs. And we also have old economy deals like oil, banks, food, consumer staples with Colonna being back by March. So we have, I would say, we don't have only tech, which would be a bit worried. Okay, could be a bit, could be of worries, but we have deal across the sector of various size. It's a very good sign for 2025.
Yeah, the perfect place to leave it. See, it is exciting again. Yeah. Wonderful to get the details. Fabienne, thank you so much. It's really great to speak with you this morning, Manish. That is Fabienne Cretin-Fumeron of Carmignac on M&A. It's back.
Good to hear. That's day two. We've heard that from Jerry Keefe, and there you've got the validation from you there in Wembley. I am envious. Beautiful backdrop. Have a great day and enjoy the rest of the week. Danny Berger in London on tour at Wembley Stadium. Here in the United States, we're 6 weeks away from, you got it, the elections. The former President Donald Trump says he will tell China to honor its trade deal with the U.S. if he returns to the White House. Here's what he had to say at an event in Pennsylvania.
The first thing I'd do is my first call, I'm going to call up President Xi. I'm going to say, you have to honor the deal you made. We made a deal. You'd buy $50 billion worth of American farm product, and I guarantee you he will buy it 100%. He will buy it. Second thing I'm going to do is I'm going to say, you have to give the death penalty to your fentanyl dealers.
Trump has been promising a litany of tax breaks to voters. He's now preparing to outline steps to lure foreign companies to the United States when he speaks in Georgia today. Our senior editor, Michael Shepard, joins me now from Washington. Mike, good morning to you. The latest that we can expect from President Trump. A lot of yesterday was about John Deere. It was about tax. So what is the latest that we can expect?
Well, today, Donald Trump is going to lean into what he calls a vision for trying to get even more manufacturing housed here to help turn the U.S. into more of an export engine and export economy than it already is. He is going to propose a series of steps that would allow the U.S. to try to lure more foreign manufacturers to house their operations here. That would include lower corporate tax rates, easier regulations, access to good ports, and to cheap energy. And some of this may have to get congressional approval, and the details are a little light on the plan, of course, but it is part of his vision for trying to boost manufacturing, one that we heard through his first term in office. He is also accompanying this with a familiar stick, and that is tariffs. It's something he talked about yesterday with respect to John Deere, and it's something he is using as a threat to companies who don't buy into this.
Well, let's just listen to what he had to say about John Deere.
I just noticed behind me John Deere tractors. I know a lot about John Deere. I love the company. But as you know, they've announced a few days ago that they're going to move a lot of their manufacturing business to Mexico. I'm just notifying John Deere right now. If you do that, we're putting a 200% tariff on everything that you want to sell into the United States.
Look, this is the classic policy that was used in the last administration. He's also promising corporate America, made in the USA, you get a cheaper tax rate, 15%. But can these levies that he's talking about really go the full way to paying for the significant tax cuts that are being promised?
Well, when we look at the cost of those tax cuts, it totals roughly $13 trillion, nearly what it costs to run the government on an annual basis. And with with those tax cuts combined with tariffs, we don't get even close in terms of tariff revenue, according to analyses by economists. And his opponent in the November election, Kamala Harris, has also seized on a big flaw in Trump's argument. He is trying to maintain that these tariffs will pay for tax cuts and that other countries will be bearing the cost. The truth is, and every economist worth their salt will tell you, that tariffs are paid in the domestic market where they're imposed. So a tariff on a product from China, the cost of that is borne by consumers here in the U.S. The prices get raised here, not in China. So Harris is able to use this, and she did so during the debate earlier this month, saying that, look, this is actually a tax in another name on the American public.
Yeah, I mean, this is where both of them try to draw the deep divide between them in terms of taxation policy for corporates with Trump and versus Harris's taxation policy for corporates and perhaps the wealthier. But let's talk about Harris, because she will be talking more about the economy, and this is where she's on the back foot against Trump in the polls. So what are we going to hear from her that's perhaps going to embolden that position?
Well, Kamala Harris has been gradually unveiling pieces of her economic agenda if she were elected. They include expanding the U.S. housing stock by adding as many as 3 million units nationwide, offering incentives to first-time home buyers. She would pay for this by raising corporate tax rates from 21% currently to 28%. Donald Trump, on the other hand, is calling for lowering corporate taxes to 15%. She is also calling for extending the Trump-era tax cuts on individuals who make less than $400,000. And paying for it also will be a tax on buybacks, for instance. All of this is trying to draw a distinction that she is aiming for the middle class and accusing Trump of aiming more for what she calls his friends in corporate America and Wall Street.
Okay, and of course he is promising no tax on Social Security. It really is grabbing at various pieces of the electorate out there. Mike Shepard on the very latest on the campaign to the White House. Coming up, we'll set you up for the rest of your trading day. Don't forget, a little bit more Fed speak and a 2-year auction. All to play for on Bloomberg. Good morning from New York. Here's a look at the rest of your day. Fed Governor Michelle Bowman speaks at 9 a.m. Eastern. Then the Conference Board Consumer Confidence at 10 a.m. And President Biden speaks at the UN General Assembly here in New York. Surveillance is up next. Context Matters from New York every day on Bloomberg. Good morning.